Hey everyone, and welcome. Today we are diving deep into one of the world's oldest and most fascinating assets, gold. But we're not just talking about your grandmother's jewelry box here. We're going to explore how you, as a modern investor in India, can use digital tools to make gold a part of your financial future. So let's get right into it.
Okay, I want to start with a number, a really big number, 35,600 tons. Just let that sink in for a second. Any idea what that could possibly be?
Well, that is the mind-boggling amount of gold just sitting in Indian households. We are talking about a value of over 307 lakh crore rupees. That's not just an asset, right? It's woven into the very fabric of our culture and our economy. And that's exactly why it's so important to understand how to invest in it smartly today.
So first things first, let's explore the fundamentals. What's the big deal with gold anyway? Why has it been this powerful, enduring asset for, well, forever? Let's find out why it's so much more than just a shiny piece of metal.
Now take a look at this. The numbers here really speak for themselves, don't they? I mean, a 40% return in the last year alone? That's incredible. And even if you look at the long game, we're talking about annual returns right up there neck and neck with major stock market indexes like the Nifty. So yeah, gold isn't just a safe asset, it can be a really high-performing one too.
Gold's real magic comes from all the different hats it can wear in your portfolio. First off, it's a safe haven. When the economy gets stormy and markets are down, investors tend to run to gold for stability. It's also a fantastic hedge against inflation, helping your money keep its buying power. Plus, it's a great diversifier because its price often zigs when stocks are zagging. And of course, especially here in India, that deep cultural significance means there's always this underlying consistent demand for.
Okay, so we get why gold is powerful. Now, let's get into the how. For generations, buying gold meant one thing, a trip to the jeweler. But today, the game has totally changed. Let's stack up that old-school approach against all the modern, digital ways to invest.
This slide lays out the classic trade-off perfectly. With physical gold, you can touch it, you can feel it, it's yours with zero counterparty risk. But you've got to deal with making charges, GST, and the stress of keeping it safe. Now on the other side, you have modern paper gold. It's incredibly efficient, super easy to buy and sell with no storage headaches. The main downsides? Well, you don't actually hold it, and for some of these options, you're going to need a demat account, which is just like a bank account but for your stocks and securities.
All right, this is the heart of it all. We're going to open up the modern gold playbook and break down the main digital options you have one by one. This way you can figure out which play is the right one for you.
First up, we've got gold ETFs. The easiest way to think about these, it's like buying a stock, but instead of a company, you're buying a tiny piece of gold. You do it right on the stock exchange through your demat account. Every single unit you buy is backed by real, 99.5% pure physical gold, locked away in a secure vault. And because it's all regulated by SEBI, it's safe, transparent, and super easy to trade.
Next, we have gold mutual funds. Now, these are amazing for anyone who wants to invest regularly without a lot of hassle. These funds basically just take your money and invest it in, you guessed it, gold ETFs. The huge win here is that you don't even need a demat account. You can start a systematic investment plan, or SIP, with as little as 500 rupees. It's a fantastic, regulated way to build up your gold holdings over time.
And then there's digital gold. You've probably seen this advertised everywhere, and it's become super popular because it's just so easy. You can hop onto an app and buy 24-karat gold for as little as 1 rupee. It's all stored for you in insured vaults. I mean, it sounds perfect, right? The ultimate in convenience. But, and this is a really big but, there's a catch you need to know about.
And here it is. This is a direct warning from SEBI. They've made it crystal clear that these products are not regulated by them or the RBI. So what does that actually mean for you? Well, it all boils down to something called counterparty risk. If the company you bought your digital gold from goes bust, there's no official safety net. There's no regulator to step in and make sure you get your money or your gold back. It's a risk you absolutely have to be aware of.
Now, for something a bit newer and really interesting, gold leasing. This is a pretty cool idea. You can take the digital gold you own and essentially rent it out to jewelers. They use it for their business, and in return, they pay you interest. But here's the kicker, you don't get paid in rupees, you get paid in more gold. We're talking an extra 2 to 5% a year. It's a neat way to make your idle gold work for you. But just remember, this is often built on those unregulated digital gold platforms, so the same risks can apply. Last but definitely not least, we have sovereign gold bonds, or SGBs. These are issued by the RBI, so they have the full backing of the government. What makes them so special is you get two benefits. You get the profit if the price of gold goes up, and you get a fixed 2.5% interest every single year. Now, it's important to note our sources say that new issues of SGBs have been discontinued, but that doesn't mean you can't buy them. You can still find them on the stock market from other investors who are selling them.
Okay, let's switch gears and talk about something nobody loves but everybody needs to understand: taxes. Because let's be real, the return you see on paper isn't always the return that actually ends up in your pocket.
This slide is super important, so let's walk through it. For most of these options, physical gold, digital gold, ETFs, and mutual funds, you're looking at a 12.5% tax on your long-term profits. But look at that bottom row. Sovereign gold bonds. If you hold an SGB for its full 8-year maturity, any profit you make from the price increase is completely tax-free. That is a massive, massive advantage that can seriously boost your final returns as a long-term investor. It's a real game changer.
Okay, so we've covered the why, the how, and the taxes. Now for the most important part, let's bring it all together and help you find a strategy that actually matches your personal goals. So I want you to take a second and really ask yourself this question. What kind of investor are you? Do you value tradition and holding something tangible? Are you a systematic planner? Or are you hunting for the most tax-efficient route possible? Your answer is your compass. So let's map this out. If you're a traditionalist who values that physical security and emotional connection, then physical gold is probably your jam. If you're more of a systematic planner who wants a disciplined, regulated, low-cost way to invest, then gold ETFs and mutual funds are going to be your best friends. For the patient, long-term saver who's all about tax efficiency and government safety, it's sovereign gold bonds all the way. And finally, if you're an innovator who loves convenience and is open to new ideas, then digital gold and gold leasing are worth exploring, just with that little bit of caution we talked about. And we'll leave you with this final thought. In a world that feels more and more uncertain, gold has proven its resilience for centuries. The only real question left is, what role could it play for you? Is gold the anchor your portfolio has been missing? Thanks for watching.